Hey there. Ever wish you could just crack the code of the stock market, get those crazy returns you always hear about? Well, today we're going to dive into the world of Peter Lynch. This is the guy who made the Magellan Fund the best performing mutual fund in the world. We're talking an average of 29.2% return every year for over a decade. That's more than double what the S&P 500 was doing. So yeah, buckle up because we're going to unpack the incredible story of Peter Lynch and learn how he turned an $18 million fund into a $14 billion giant. That's pretty remarkable. So Peter Lynch's story starts back in 1944. Sadly, his dad passed away from brain cancer when he was only 10. To help his family, he started caddying at a young age. And get this, his fascination with the stock market actually began on the golf course. Can you believe that? He'd be out there lugging golf bags and overhear these investors talking about their stock picks and strategies. Who knew that those overheard conversations would end up sparking a lifelong passion? It's pretty amazing. And that passion led him to make his very first investment, 100 shares of Flying Tiger Airlines at just $7 a share when he was a sophomore in college. And guess what? That stock later soared to $80 a share. Talk about beginner's luck. But it just goes to show, sometimes when you see an opportunity, you got to take it. Now, the profits from that savvy investment helped him pay for his education at Boston College. He graduated with degrees in history, psychology, and philosophy. Talk about a well-rounded education. And then he went on to earn an MBA from the Wharton School of the University of Pennsylvania. Pretty impressive. But here's where things get really interesting. Remember those summer internships everyone always talks about? Well, in 1966, Lynch landed one at Fidelity Investments. And it was his caddying connections that got him the job. He had actually caddied for Fidelity's president. Talk about the power of networking, right? It's really all about who you know sometimes. So after serving in the Army for 2 years, Lynch returned to Fidelity in 1969. He started out covering various industries like textiles, metals, mining, and chemicals. By 1974, he had climbed the ranks and become Fidelity's director of research. Not bad for someone in their early 30s. Really impressive. But the real magic happened in 1977, when he was appointed the head of the Magellan Fund. It was a relatively small fund at the time, managing about $18 million in assets. But under Lynch's leadership, get this, it grew to a mind-blowing $14 billion by the time he retired in 1990. I mean, can you imagine that kind of growth? It's just incredible. So how did he do it? Well, one of Lynch's most famous sayings is, invest in what you know. It's brilliant in its simplicity. He believed that everyday investors like you and me have an advantage because we can spot trends and opportunities in our daily lives, things that Wall Street might miss. They're not out there living our lives. And he practiced what he preached. He invested in Dunkin' Donuts simply because he loved their coffee and saw how popular they were. And it wasn't just a random guess. He carefully studied the company's investments. And guess what? It turned out to be one of his most successful investments. It's the beauty of Lynch's philosophy. It's all about combining personal observation with solid research. Now, Lynch also wasn't afraid to challenge conventional wisdom. He'd kind of go against the grain. He believed that real-world investing sometimes contradicted what he learned in those fancy business schools. He questioned academic theories and placed more emphasis on practical experience and observation, rather than those complex theoretical models. He even went so far as to say, it seemed to me that what was supposed to help you succeed in the investment business could only help you fail. Quantitative analysis taught me that the things I saw happening at Fidelity couldn't really be happening. Pretty bold statement, right? But he was really challenging those traditional ways of thinking. Another fascinating aspect of Lynch's approach is his concept of 10-baggers. That's a term he borrowed from baseball. It basically refers to an investment that increases tenfold in value. Just imagine finding a stock like that. He looked for companies with the potential to deliver those exceptional long-term returns. And while we're on the topic of the long game, Lynch was a big advocate against market timing, trying to predict those short-term market swings. He believed it was a losing game, and that investors were better off focusing on finding great companies and holding them for the long haul.
He once said, far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in the corrections themselves. It really highlights his philosophy of staying invested and riding out those market fluctuations, not getting scared and selling everything when things dip a little bit. So that's a bit about Peter Lynch's early life and how he got started in investing. In the next part, we'll dive deeper into the inner workings of the Magellan Fund and uncover the specific stocks that made it such a phenomenal success. It's really quite fascinating. So stay tuned for part 2. Welcome back. So before we get into the specific stocks that Peter Lynch picked for the Magellan Fund, let's talk about his overall approach. Lynch wasn't afraid to diversify. He'd invest in companies of all sizes, both here in the US and internationally. He believed you could find great investment opportunities in any sector, as long as you are willing to put in the work and do your research. He looked for companies with strong earnings growth, solid financials, and of course, a reasonable price. He didn't want to overpay for anything.
In his book, Beating the Street, Lynch actually reveals some of his top picks from his time at the helm of the Magellan Fund. And the list is pretty interesting. At the top, we see names like Fannie Mae, Ford, Philip Morris, MCI, Volvo, General Electric, General Public Utilities, Student Loan Marketing, Kemper, and Lowe's. Now think about that for a second. That's a mix of industries, from finance and automobiles to consumer goods and utilities. It just goes to show you that Lynch wasn't afraid to spread his bets and invest in a wide range of businesses. But here's the key. One of Lynch's real talents was his ability to spot companies before they became Wall Street darlings. He was often way ahead of the curve, finding those hidden gems before the big institutional investors caught on. And how did he do it? Well, he paid close attention to consumer trends, industry developments, and did his homework. He wasn't afraid to go against the grain and invest in companies that others might have overlooked. Now remember his idea of invest in what you know. Well, Lynch also called this local knowledge. He believed that individual investors have a unique advantage because they can gain insights into companies and industries just by going about their daily lives. Think about it. You might have firsthand experience with a product, service, or even a retail store that Wall Street analysts are completely clueless about. That's valuable information. Lynch encouraged investors to use this local knowledge as a starting point. He believed that by combining your own personal observations with some good old-fashioned financial analysis, you could uncover those hidden gems in the stock market. And once you've found those promising companies, what's the next step? Well, according to Lynch, it's all about patience. He believed that real success in investing comes from finding great companies and holding on to them for the long run. He wasn't interested in those quick flips or trying to time the market. He believed in building a solid portfolio of quality businesses and letting them grow over time. It's like planting a tree and watching it grow into a mighty oak. Now, Lynch also had a specific checklist he'd use to evaluate potential investments. And this checklist was pretty comprehensive. It covered everything from earnings growth and debt levels to the quality of the management team and the competitive landscape of the industry. For instance, he looked for companies that had a consistent history of earnings growth. He believed that earnings were the engine that drove stock prices, and companies with strong earnings growth were more likely to perform well in the long run. He also paid close attention to a company's debt levels. He preferred companies that weren't drowning in debt because it gave them more flexibility and reduced their risk. He wanted to see companies that could use debt wisely to fuel their growth without taking on too much risk. But it wasn't just about numbers. Lynch also looked at things like the quality of the management team. He believed a strong management team was crucial for long-term success. He looked for leaders who were honest, capable, and had a clear vision for the future of the company. And just as importantly, he wanted to see management teams that were aligned with the interests of the shareholders, those who were focused on creating value for the investors. Another factor Lynch considered was the competitive landscape of the industry. He wanted to invest in companies that had a strong competitive advantage, a real edge over their rivals. He looked for companies that had a solid market position, a loyal customer base, and a track record of innovation. These were the companies that could stand up to the competition and stay profitable for years to come. Now, it's important to understand that Lynch didn't have a rigid set of rules. He was flexible in his approach, adapting his criteria based on the specific company and the industry it was in. He believed that investing was both an art and a science, requiring both careful analysis of the numbers and good judgment about the qualitative aspects of the business. So to sum it up, Peter Lynch's success with the Magellan Fund was built on several key factors: his willingness to diversify, his ability to spot potential winners early on, his focus on local knowledge, his emphasis on long-term thinking, and his thorough research process. His story really shows the power of active investing and the potential for everyday investors to achieve incredible results in the stock market. But here's the question: how can you, as a listener, apply these principles to your own journey in the stock market? What can you take away from his experience to make smarter investment choices? That's exactly what we'll be discussing in the final part of our deep dive into the world of Peter Lynch. Welcome back. We've talked a lot about Peter Lynch, his journey, his incredible success with the Magellan Fund. But now, let's bring it all home and focus on what you can actually learn and apply from his experience. So first and foremost, remember that powerful idea: invest in what you know. You know what? Don't feel like you have to jump into these complicated industries just because everyone else is. Think about the things you use, the companies you really admire, or the industries that just really pique your interest. Lynch believed that those everyday experiences could give you a real advantage. You know, when it comes to spotting potential investment opportunities. But don't stop at just like casual observation. Take the time to do your homework. Don't just blindly follow tips or recommendations. Really dig into a company's business model, their financials, and really try to understand their competitive landscape. You know, look at things like industry reports. Analyze those financial statements. And if you can, talk to people who work in the industry.
Get a real feel for what's going on. And once you've found some promising companies, it's time to think long-term. Don't get caught up in all that short-term market noise. Remember Lynch's philosophy. Find those great companies and hold on to them. Be patient. Let your investments grow over time. And don't be afraid to go against the crowd. You know, some of Lynch's best investments were in companies that Wall Street initially overlooked. So if you've done your research and you really believe in a company's potential, don't let the opinions of others deter you. Trust your own judgment. But remember, even with a great company, you don't want to overpay. Look at valuation metrics, like the price-to-earnings ratio, price-to-book ratio, price-to-sales ratio. All those tools can help you determine if a stock is reasonably priced. Lynch called this GARP, growth at a reasonable price. It's about finding that sweet spot, where growth potential meets a sensible price tag. Now, to manage your risk, it's smart to diversify your portfolio. Don't put all your eggs in one basket. Spread your investments across different industries and sectors to help reduce your overall risk. And of course, stay informed.
Keep up with what's happening in the industries you're interested in. Stay on top of company news and pay attention to those broader economic trends. The more you know, the better prepared you'll be to make sound investment decisions. Remember, investing is a journey, not a sprint. There will be ups and downs along the way. But don't get discouraged. Learn from your mistakes, stay disciplined, and keep that long-term focus. Peter Lynch's story is a fantastic reminder that you don't need to be a Wall Street guru to be a successful investor. With common sense, thorough research, and a long-term mindset, you can take control of your financial future. So take inspiration from Peter Lynch's incredible journey, learn from his principles, and start building your own path to financial success. If you enjoy this deep dive, hit that subscribe button for more fascinating stories and insights into the world of investing. Until next time, happy investing.